Hi, Warriors. Everything's green, weaker dollar, stronger WTI, stronger S&Ps, metals flying. How's everyone today? Hi,
It's
Kareem,
Metal
Mike.
Mania. Metal Mania.
Yeah, it is.
I know.
Ma-
It wasn't that the title
Wrestle.
of your video with Maggie Lake this weekend?
I'm not sure. Is that what you used?
I think that's what she used. I think, but
Uh,
man, it's crazy, right? These moves in like platinum and palladium and gold at all time highs, nuts,
yeah.
right?
Well, that it's what the market believes
That's
for the
right,
moment, right? So
right.
can't fight it. Although I'll try. Michael Weissman, how are you? Steve, Kman, Andrew, AJ Brand, AJ Kale. Hello, welcome to Face. Linda Parth, welcome to Face. How are you? Stephen Marty loves it. He's long. Maybe I should just play with all my physical silver coins today and pretend I'm Ebenezer Scrooge. Metallica, yeah. Metallica was ahead of their time. They knew there was a bull market coming, right? You miss heavy metal? Well, there's always YouTube, right? Any heavy metal band? Do you listen to Led Zeppelin? They were the first. So we have a weaker dollar starting off here. Let's see. K-Man's here. Hi, K-Man. How are you, buddy?
Dale, good morning. Good morning, everybody.
All right. So a little bit of a pop here in
Mhm.
euro. This 117 level. It could be forming a descending triangle here. If we, rally but don't and put in a failing rally and then break down, it's going to give you 116. So we'll see. Do you think there's enough juice for the euro to make new highs with everything else, like S&Ps are trying, and we know
Oh,
what the gold has done.
um, New highs is a big ask unless the flows are really massively that way. But we've been talking about those flows last Friday, and looking at what the equity markets are doing, the U.S. equity markets, whatever the models may have called for, may already be obsolete. So I I'm not going to make too many predictions, but it's all about unless there are headlines all about the year-end flows now. I mean, yeah, I mean it was a decent hold around 117. Not going to deny that, but what's what's the next leg is a bit up in the air. I actually wouldn't be surprised if we drag a little higher, but
You're
uh,
you're not looking for new highs. New highs would surprise you.
oh, new highs would be a bit surprising, yes. I mean, if
Okay.
it's if I'm totally if I'm looking at one fundamentals, two minor expectations for flows, but with a bag of salt, I would be surprised if we see fresh highs. You mean above the fresh high, above the 119, right?
No, above 118, fresh highs
Oh,
for
okay, up towards 118, 118.20. Yeah, that could easily be done. But I don't see any reason why we would get any closer to 120, that prior 119.30 from a while back, right? That would be a bit surprising, because there's not too many reasons really for going there on data, etc.
your tone sounds to me like the fundamentals. Are you talking about that there are positive or negative fundamentals?
They're very average. You know, the if we look at growth in the US is still better than in the Eurozone, but there is on the counter on the counter argument would be that the outlook for Europe may be at least more stable. So my fundamental thought is that we should not be moving too far away from where we are now, and But you know, I mean, month, quarter, year-end flows, they can drag us everywhere. But on the fundamentals, I don't see too many reasons why right here and now, euro dollar should move much higher. The one
So
thing that
interest rate differentials are neutral. Is that what you're saying?
yeah, but they are still somewhere still in favor of the US. The US interest rates are higher than the
Yeah.
euro, but the differentials have narrowed a bit. So that alleviates the pressure to the downside. Um, what the only thing that could really, to me, drive euro fundamentally higher is that there is a big shortfall on receivables in the US, meaning that tariffs don't bring in what they need to sponsor all the spending in the US. That could weigh on the dollar, but it's not something that the market will be trading right here and now into year end at least.
Okay.
Uh,
Cable
I
looks
think
like it's just a layup for new recovery guys there.
yeah, and there I agree. There I agree. And as a matter of fact, yeah, end of last week, I greatly, and this morning even, even further reduced long euro sterling because I don't want to pay for the carry until year end. Where the fundamentals for sterling may be still getting worse in the future. In the here and now, we have to acknowledge that the sterling hasn't been doing badly over the budget and through the Bank of England. So on
Well,
the cable, I would not be surprised if we go for a walk higher into year end.
you have levels.
135 three quarters is one that I've noted on my little pad. Um,
Here.
Somewhere around, no, a bit higher. Yep, you see there in
Oh
August,
yeah. Yeah.
July, August, September, those high there, very
Yeah,
close to
good.
136.
I couldn't draw my lines without you, man.
Nah,
So you call it 35. Yeah, I see you. You're looking at
yeah,
these
35
highs
three
right
quarter,
here.
36. And I'm wrestling with the same reasoning as to why cables should go up to 137, 138, unless we have those some stupid year-end flows in an illiquid market. And by the way, just talking about those flows in the market, I think there is a bit of a risk of real illiquidity because Christmas and New Year fall like in somewhere in the middle of the week, right? On a
Yeah.
Thursday. So meaning the Friday the liquidity providers won't give the liquidity either. So and then taking into account that they won't give the liquidity on the 24th nor the 31st, it's actually in 2 weeks gives you only four real trading days. And so I think the flows could be concentrated on fewer days than when Christmas and New Year fall on a weekend.
Okay. All right.
And the other,
Any comment on we're pulling back a little? Did rates
yeah,
JGBs soften up a little bit?
yeah, the we had like the the new Mr. Yen official Mr. Yen Mimura in Japan. They warned again for interventions that the yen is not moving so in the right direction. So yeah, we're still in we're still in intervention risk territory, I would say. But against that, if you look at yen crosses, for instance, they are not giving back. And, look at that sterling yen 211. You know, last week we were wondering what it was going to do at 207 to 208 with 2% higher. It's, I mean, I don't see any natural path for the yen to materially strengthen right here and now. It will have to be from interventions. Maybe 2026 is going to be a different story, but here and now, unless we get interventions, I don't see why dollar yen should really come down.
Okay. So I think we have currencies covered except for commodity currencies. You like Aussie again? Are you
Yeah,
back long?
yeah. I actually last week I bought Aussie Kiwi. And looking at the Kiwi starting to drag a bit higher, I bought the Kiwi against it, so I'm actually a little long Aussie dollar again.
Okay.
I
Shit,
like
something
both.
just hit the yen. Something just hit the yen.
Oh
Sorry,
yeah,
guys.
oh yeah. Here we go.
Yep. So go pull
Maybe
up the
rates
yen.
checking also.
Good eye.
Maybe rates checking also. Yep, 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 yep. This is coming down now.
I think you buy it at 6.5 with the money stop and
Yeah,
still see,
that's what I said on my morning updates. I think 156. What did I say? 3070 is the natural level, I would say.
yeah.
Yeah,
Because they
Trump
tried
recalls 48 ambassadors at embassies.
from
sorry.
where?
That's Washington Post. So Trump is calling back.
What
Yeah,
country?
Whoa.
yeah. That's
What?
that's different than what we were thinking.
Yeah.
But apparently Katayama was out at the same time as well.
Oh,
On intervention, perhaps.
oh.
Well,
Well,
I mean,
Blake, it's sure looking like we're pretty close to going in, or at least WTI thinks there's something afoot.
Yeah, well, yeah. Crude definitely looks really good. I mean,
yeah.
it's a nice false breakdown. It looks great. I'm sorry, I'm just looking around at stuff, Dale.
Oh, that's all
So,
right, man.
trying to pay attention to you
Yeah,
at the
it's
same time. But
okay.
yeah, crude
No,
does look great. And it's that hold at $55 was ginormous.
yeah,
It was huge.
yeah, yeah. It
Yeah.
looks good.
What
So,
did Katayama say?
Well, I don't know. James put it on. I'm asking him.
Okay. Oh,
Um,
James. Oh, okay. All right. So, in our chat room,
yeah.
James is letting us know that there's something happening, and so we're trying to see what
Yeah.
she said. But at the same time, like I
What's
said,
that?
there's
What's that story about those 48 U.S. ambassadors? Okay, it's probably to do with migration, etc., but also
no.
uh
Venezuela.
oh, Japan's finance minister Katayama says we can have a
Oh,
U.S.
yeah.
U.S.
She says we
Japan
have
joint
a free hand to take bold action on yen.
and
That's
with a
also one of the lines.
joint U.S. accord. So
Yeah,
that's
yeah.
kind
Oh,
of
so we're,
important.
oh, okay. So they're going to help them. That's
No,
what.
no. As they can take action as set out in the U.S.-Japan Joint Accord. Yeah, I mean, they can do it either alone or with the U.S.
I
When
think, but I think I've been saying for a few weeks, I think the
mm,
U.S. is going to participate
could do
because, yeah,
Yeah.
yeah,
could
Besson
play.
doesn't like
Yeah, yeah.
this
Besant
either.
has been saying it from the start, right?
Yeah.
That they would
So,
at least agree with it.
yeah. So maybe they wait for the thinnest day of the year
Wow.
before the year ends, right? Like right before New Year's or something. Or
Yeah,
they could do it now. It's pretty thin
yeah. They
right
could do it
now.
now. I always say like when I look back at from experience, when I was in banks, the and that's what I said on Friday as well. I said watch the U.S. Open because that's when the US is really officially open, whatever, and that's always a moment that I'm pretty closely watching. If there is intervention risk, they could do it right on the US Open, right?
Okay.
Yeah, that's
Where's the top in goals? Came in.
Um, Today or in general?
Uh, no, forever.
Forever. 7,000. The gold is going to
50,
catch up.
50.
Gold is going to catch up on the S&P.
Yeah, well, they'll go 1 to 1.
Um, Nah, I
Yeah,
always said that I thought metals would end the year on a good note. I don't know, man. I mean, 40, 45, 45 and a half is an extension level as well. 45.17 is one. Um, and then you're looking at
yeah,
4,700 basically.
yeah. I can't answer that question, but I do think that copper has rallied in sympathy with all of this. And take a picture. There's a 1, 2, 3 drives to a top. A much weaker looking chart than the
Mm,
precious.
mm.
So I don't know. I wouldn't be long copper right here. So a lot of people are treating it as a precious metal because they don't make
Mm,
pennies any
I,
pennies from heaven for you
I
and
think
me.
I don't think they take it as a precious metal, but I think the market says like, oh, if they need silver, they might need
Oh
copper as
yeah,
well, right?
the build out.
Yeah.
Yeah, okay.
To build all
So
those drones.
yeah, drones and to build out for the data centers, they're going to need a lot of copper.
Hmm.
So, all right. So, what do you think of yields here? I still think they want to, take out 420.
Yeah, I don't know. I looked at the year-to-date performance on bonds on Friday. They've been doing all right. I don't know if there's any rebalancing to do for year end. In which case, you're going to see probably 425, 430 on the tens before the year is over. But
Yeah,
I don't know if they need to really rebalance or not.
yeah. This used to be a liquid market. You didn't, I could probably go back, a few years, but you didn't see like area gaps all over the
Hmm.
place in
When did
TLT.
those start? Those gaps? Give me a date.
1970.
No,
See,
the
see,
gaps.
it's
No, the
hard to
gaps.
tell
When
with
did the
weekly.
gaps start this year?
This year, it's
Take
been
just.
going longer than this year,
Oh, really? Oh, okay.
but
Oh, I thought I
so it
thought we
was
had a
in.
I thought we had a good gap start from when Trump was going to be winning the elections.
Okay,
Mm,
yeah, I don't see any. They don't look good to me. I mean, I know guys have been bullish bonds for years now. That was a defensive play, and yeah, they must have the patience of Job
mm.
because when you look at this, it's almost like watching paint dry.
I mean, are you not getting paid to be long bonds?
Yeah, you get paid.
No.
And then you have the
Yeah.
risk of losing the value in currency and higher yields here,
Mm,
but you get paid.
yeah.
Except the people in Europe that bought bonds at negative rates. I don't think they're worth too much money anymore.
No, of
And
course not.
and they were paying, or even the people that had a half a point coupon.
Mm,
So, there's got to be bond losses everywhere from when rates were low. And you got to think there's big bond losses in the JGBs too, for as long as they were kept there at zero, that this
yeah,
kind of
but
rate move probably killed
I
those
wouldn't.
bonds.
I wouldn't worry too much for the Japanese investors. And they have been reducing the long end for a very long time, and they've got into foreign assets. JPIF or GPIF, sorry, they have and all the Japanese whales, they all have reported record profit. Yeah,
In their
on,
wills,
on history.
you mean, oh, the
The
wills,
Japanese
what they're,
investors who are typically in the JGB market, right?
yeah,
They
yeah,
should, if they would have stayed in JGB the way they were 10 years ago, of
yeah.
course they would have been losing a lot of money. But they all came up with record profits because they diversified so much that I wouldn't worry for them.
Well, I'm not. Yeah, I'm just talking about someone bought them. Maybe retail was, avoided this,
Yeah.
but Japanese banks and the government must own them, right? Who
Yeah.
bought them?
Well,
Who bought
the
them?
Japanese government, but and the BOJ, but that's all paper money. Yeah.
Yeah, yeah.
The paper losses, yeah, why not? But I mean, just print a few more and the loss is gone.
Okay. All right. So Bitcoin, want to address it? Maybe this is the bottom.
It's the bottom of a flag.
That's not a flag anymore.
It is. Yeah, it is.
You're a little faint, Blake. Good morning.
I
If
know. I
you,
actually
oh,
replaced my
okay,
microphone, and I'm getting a new microphone. Right. I'll be putting that in, installing it
okay.
today.
So this is what you're seeing, Blake, right here. We're
Uh,
right there on the
do,
underside of the breakdown of the flag.
no, sir.
All right, I'm going to give you the charts.
All right.
I'm curious.
Yep. All right. You want to talk about you want to talk about Bitcoin really quick?
Yeah,
Here is the Bitcoin. I'm trying to talk loud just so you guys can hear me.
yeah,
I
you're
just want to
loud and
make sure.
clear.
All right. Here's Bitcoin.
Yeah.
Here's the flag pattern.
Oh, I see.
And yeah, the week ahead video 2 weeks ago. I said, hey, as long as we hold above 86,000, we dip just a little bit lower below it, and we're holding it. So I still believe that we're in a bear flag pattern, but because we're at the end of year and we're seeing all these, obviously the stock market's rallying, precious metals are
Everything.
rallying, the dollar's pulling back. All these flows are probably going to just drag Bitcoin back up. And as I said on Friday on the week ahead video this week, we're probably going to see 94,400 again. And that's going to be a big level. That's a big resistance. And if we can get above that, 98,000 is the top of the flag. Should we get up there, if there's enough to push us up there. But I think those are the levels that we're going to be seeing as long as this holds. So, yeah, I mean, that's just kind of the way I
There's an
see it.
interesting ratio chart. I was being interviewed, and one of the viewers asked me to look at it. I never looked at it before, but pull up a Bitcoin gold ratio chart.
It
Okay,
looks like
see?
the silver gold ratio. Doesn't it? I mean,
Yeah,
yeah,
yeah.
it's
But it
ugly.
looks about, I don't know, it looks like, it might be setting something up at major support. This will tell you when to buy Bitcoin. Okay. It's really not directional, these kinds of ratios, but you can see how Bitcoin's been getting killed against gold, and we're at some major support. You're right. It does look like the gold silver ratio at major support here. Anyway, something to keep an eye on. So you still have lower off that. You know what?
Um,
Besides being a very good technician, you are a fast draw, man. I mean,
Thanks, buddy.
you just pull a chart out of your holster at the speed of light, Blake. Unbelievable. Speed of light,
Uh,
man.
yeah. Well, looking around though, we have the euro that's supported by this rising trend line. We've been talking about it this week. The end of year flows is as Kman, as you said a bit ago, most of the banks are looking for, some dollar buying, but maybe some of those flows have been done already.
No, and I think the way the equities moved, if it's model based, those flows will be gone. They shouldn't happen anymore because the equity market rallied 2% from Friday.
Right. So, I mean, with the equity markets continuing to push up towards highs, it could usher in and this is one thing that I talked about on Friday on the week ahead video. If buyers continue to come in, you're selling dollars to buy everything else. I mean, that's
Yeah.
just kind of how
One
how
market. Yeah.
what's that?
One market. It's
It's
pretty
one
much been
market.
that for years now.
And Dale, we have FOMO, YOLO, FOMO. I mean,
Mhm.
and I'll explain the dynamic that I'm going to just say it
YOLO.
again. If you watch the week ahead video, you might have watched it just a couple of minutes ago when I sent it out earlier this morning too. I mean, you have a situation where we had Liberation Day. Here's where the market started this year, right? We started here. We're up 15% on the year. Liberation Day came and went. People got out here. People were hesitant to get in even here. And retail was buying right here. That was retail. And all the fund managers, they sat around on the sidelines saying, this is crazy. We're going to, Trump's tariffs
Yeah.
are going to wreck the market, blah, blah, blah. And now everybody's been chasing, like literally for the remainder of the year. And if you're not up 15% right now, you're at risk of redemptions. And you're at risk of redemptions next year. So you gotta make money at this time, and you have a very short period to do it. And as one of the traders in our chat room yesterday was saying, or on last weekend was saying, everybody's trying to make their year in a week.
It's tough to do.
It is tough to do, but YOLO, you only live once, and FOMO, if you're fear of missing out right now, you're chasing the market higher.
Yeah.
That's
you have what are your numbers above 67 for possible?
Well, it would be 7,000.
I mean 7,000. I meant, yeah.
Not much further than that. I mean, you got like maybe 7,100. I think is what we have up here. It's the 127% extension, or excuse me,
Yeah.
161% extension would be just above 7,000, so 7,050. Can't you imagine, Dale, that just gets taken out to the upside, and
Yeah,
we
throw
close
over.
the year at highs above channel resistance, and then we figure out what we're going to do next week or in 2 weeks?
Yeah, I could see both cases in this environment, but you're right with the dollar weakness. The market doesn't turn, and I know there's not a tight correlation, but everything is going up together. So I think the dollar is the key. Dollar keeps cratering, everything keeps going up.
Yeah,
Dollar
and
turns, it might change it.
right, and so that's when you and by the way, if you missed the Katayama headlines, they're right here on Live Squawk, in black. You can see them clearly. The thing about the dollar is you just look at the overall just looks of the dollar, and what's happened is the dollar has just been under pressure all year long, and it's just not trading well. And if here we are at the end of the year, and you've seen it just get destroyed all year long, and all we're doing is consolidating around these lows. What happens if we break this like 14-year trend line?
Then it's got big problems going to
Yeah.
90, then 85, then 80.
Right. And
Yeah.
we've seen a lot of comments of the and I'm going to get Kman's input here. You see a lot of comments from these potential incoming Fed chairs, whoever it might be, whether it's Hassett or one of the Kevins. I mean, any which way you slice it, Kman, you're going to get a Trump yes man. Even Hassett this weekend said something to this effect. Whoever Trump brings in, he won't have to worry about the Fed anymore. That's what
Yeah,
Hassett
and that
said.
could mean that the market is going to trade the Fed put for a while, so on the dollar. So, but it's also going to be very positive. It should be very positive for risk, because if you don't care about inflation anymore,
Right.
and you bring the rates lower, even pushing inflation higher, it's opening the door to even more euphoria on the equity markets.
Well, it
Right.
also reinforces the debasement narrative
Yeah.
that everyone's embraced 100% now. That's why I think there's an interruption in the debasement narrative coming up before it won't be debasement, it'll be deracement to debasement. So to the basement.
Well, maybe
Yeah.
it's a little derangement ahead of
Yeah.
debasement.
Yeah.
So,
To the basement.
so
Yeah.
as you guys can see, Kevin Hassett's still,
Getting
He
faint
wants,
again.
oh, sorry guys. As you can see, Kevin Hassett is he's the favorite at this point, as potential, Fed
Getting
chair.
worse, Blake.
All right.
You're
Well,
further and further away.
yeah, I'm going to change out my microphone today. So, as a matter of fact, I think I might do that before the morning edge. So,
Yeah.
which we will
okay.
have in approximately 45 minutes from now. So, Dale, I'm going to pass it over to you
Okay,
and
buddy.
have a great interview. And we're going to be here tomorrow. We're going to be here tomorrow. We have Canadian GDP. No. We have Canadian GDP and also US preliminary GDP, durable goods orders, all tomorrow morning here on the F.A.C.E show. We will be covering the markets live. So
Cool.
make sure you guys are back here tomorrow.
Okay, thank you, Kman.
More
Thank
than
you,
welcome,
Blake.
Dale. Thank you, Coach.
All right, guys. Have a great day. Danny Diane, how are you, buddy? Let me unmute you. Can you unmute Danny? There you go.
Can you hear me now? Is that
Yeah,
better?
I could hear you now. In fact, you know what? It's really groovy to see you.
You like the title of my year
Yeah,
ahead.
you're talking about
Well,
my,
first of all, happy holidays, Dale. Happy holidays to
yeah,
everyone.
you too, buddy.
Really happy to be back, and it should be another interesting year ahead.
Yeah, so there's some analogs that you're following from the 60s with the current setup. What is a tie-in between the 60s and what you see coming forward in 2026?
Yeah, I think, the Fed chose their mandate, right? Like they have conflicts with their two mandates. The Fed
Yeah,
chose their mandate. When I look at what we're seeing in the labor market, it's a very complicated labor market. We're seeing supply slow. We're also seeing demand, slow for labor. Although we're seeing some forward-looking indicators that point up. And I'm thinking that just like the 1960s, they were preoccupied with their models. In the 1960s, they were preoccupied with NAIRU, which is like their estimate of full employment. At the time, they thought it was 3.5%, and any deviation from that required a strict response. In 1967, the unemployment rate went from 3.5% to 4%. The Fed panicked, cut by 200 basis points. And that ended up being a big mistake. In hindsight, what they didn't catch was that this was the baby boomers coming into the labor market. You had new entrants into the labor
okay,
market. It was
right.
just simply a matching problem. It takes time for people to get jobs. It took time for the college graduates to take jobs. And temporarily, that just meant a little bit of a higher unemployment rate that wasn't signaling a catastrophe in the economy. When I look at today, I see something similar. I see, not exactly the same, but I see aggregate demand is very strong. So I'm going to let me share my screen and I'll share some charts. When we look at, aggregate demand, it remains very strong. Can you see my
Yeah,
screen?
got it.
Okay, good.
Yep.
When you see, here's my measure of potential growth, how it trends over this cycle. Typically in a cycle, if we were, heading towards a slowdown or recession that required the Fed to ease, we would see actual growth slow towards its potential at a certain point, and then at a certain point it would go below potential, and that's typically when the Fed is coming in and easing. We've never seen that this cycle at all. We continue to grow well above potential. And in my opinion, the Fed is dismissing or underestimating aggregate demand. You saw, consumer spending remains strong. Here on the right, we have financial conditions strong. Now, in the labor market, we have, if you look at the flows of labor, what we have is the prime age, unemployment rate has not moved in 3 years. Jobless claims have not moved in 3 years. The layoff rate has not moved in 3 years, but we've had a move up in the unemployment rate. And in the last few months, what we can see is that's been driven by the labor force actually grew by 800,000 in the last 3 months. And so, that is new entrants coming into the labor market.
Who
And
are
in a way, that is
who are they? People that just just didn't need to get back into the job market and are, or We know it's not immigration. Where are these 800,000 coming from? They woke up one day, said, you know what? I think I'll get a job. Where are they coming
Well,
from?
it's not all new entrants. So some of it is, people coming back into the workforce that may have been out of the workforce. It could be,
Yeah.
there's a lot of different possibilities.
Okay.
But what we see in the unemployment rate, the biggest driver is new entrants. And the new entrants, like you said, we don't really have any strong immigration at this point. So that has
Right.
to be people who have never worked before. And that
Right.
is only college graduates.
And
High school graduates.
they're not finding anything.
No, in fact, what we're seeing there is the unemployment rate for the youth is higher. And like in the 1960s, the Fed, is looking at that and saying that's a sign that the labor market might fall apart. But really, I think what we're seeing is a slow moving story that has been going on for quite a while, where the hiring rate for college graduates has been going down since 2000. It's not really a new dynamic. But what we are seeing is that they're dominating the flows in the labor market at the moment. And so that actually does nudge up temporarily, at least, the unemployment rate until they get jobs. And they will get jobs eventually. And then you'll see this, recover. But, we were debating for the last 3 years, the Fed doing soft landing, targeting soft landing, targeting adjustment cuts. They've now delivered 175 bips of cuts, in a little over 12 months, 14 months. And that's no longer adjustment cuts. That's no longer soft landing. So
That's
my view
easy.
is
Yeah.
it's easy. They've done
Yeah.
a full easing cycle. They may not be done, but they've done a full easing cycle for a 0.25% rise in the unemployment rate over this period. That is very, very high. The other reason I like to look at the 1960s as a comparison is the amount of money printing we are doing outside of a recession has actually only been compared to that period, the 1967. We have
Yeah.
6% budget deficit. We have 5% money supply growth. That is a lot of money printing, and you see that 10% hurdle is usually only in a recession, and
We
yet the
also
only
had
other time
Vietnam, Danny, right? And
that Vietnam.
and now we're looking at South American Vietnam.
Right now we have, attacking ships in Venezuela.
Yeah.
No one really talked about the fact that, there were quite a few strikes on Syria last week as well. Although I don't think that's going to go, for a long time. But, we have a geopolitically driven world in a way that is similar to the 60s.
And I wanted to ask you that maybe is it possible that the Fed sees things when they started easing, and it's been for a while, that they're not talking about, and they point to this to have you look in this direction. But could it just have maybe something to do with what they saw happening in the repo market, in private credit? Something they see where the banks might have some issues and they're trying to get in front of a financial event like all the debt being rolled over for real estate next year, etc.
So that wouldn't be a decision for rate cuts, but that is what they're doing with the balance sheet. They did see that liquidity in the financial system tightened a lot, and it actually tightened. So I'm glad you were talking about the dollar before I jumped on, because I think that's very important, and we'll get to that in a sec. But the liquidity in the financial system tightened a lot from July through November, and part of that was the shutdown. But it was before the shutdown as well. So it started before the shutdown as well. So the repo issues and the funding issues, those are legitimate issues, and that's why they're expanding their balance sheet, and they're calling it not QE, but it is still a form of balance sheet expansion and reserve expansion. That liquidity shortfall, the decline in the liquidity was a decent reason that the dollar was a lot stronger than fundamentals said it should have been. I mean, the Fed was moving towards rate cuts.
Yeah.
that no one else really, no other central bank in the world is, other than the Bank of England, is really cutting rates at this point. And, over this period, you would have expected the dollar to weaken. It was strengthening. And then in November, that started to relax a bit. So I think that's a big reason why the dollar was on this sort of mini rampage or counter trend rally from September
You
through
think it's
November.
over, Danny? The dollar rally is
I,
over and we're on our way to new lows, take out that 96 and a half
I
range.
have mixed views. I have mixed views. So at a high level,
Well, welcome to
I think,
trading.
yeah. I mean, I'll kind of set both sides of the argument. I lean on the dollar bearish side, but I did catch you on Maggie Lake on Friday with your counter trend
Yeah.
expectation, and I think there's a good reason that could play out. But let me kind of go through all of it. Look, if you
Okay.
have a Fed that is ignoring inflation and cutting rates, that's dollar bearish. If you have you have the rest of the world, done with rate cuts, cyclically improving. You have Australia, Canada, even the Eurozone, New Zealand, South Korea. They're all starting to price the possibility of hikes. And the Fed is still talking about cutting rates. That is, dollar bearish, as well. And then the attacks on the Fed from the White House is dollar bearish. At the same time, you can make, what's the argument to make for dollar strength? The argument to make for dollar strength is, have we priced all of that in? And the reason I ask that is, we're not going to be pricing in Australia, Canada, and all these other countries 200 bip rate hike cycles, right? Like, we're talking about 1 or 2 rate hikes, on the docket for the next year. And, can we just price more of that right now? I would say it's possible, but we'll need months of data to do that. So we're not going to get that immediately, right? In terms of more rate hikes priced there.
Okay.
Maybe Japan, but not in those economies. And then on the
How
other
about,
side,
oh, go ahead. I mean, I'm
yeah,
just one other argument is a big, beautiful bill. One of our attendees, JV, said aggregate demand is currently strong, Dale. What is your guest thoughts about next year with tax incentives, expensing, many companies building factories in the U.S.? Are we going to have a growth spurt in the first quarter due to this
yeah.
legislation?
My thinking is the fiscal impulse turns positive again. And then you have this rate cut cycle, which, it works with lags and it should kick in. In particular, that's what I wanted to get through. So some of
Okay,
these charts, let's go through that. But let me
right.
throw out the last point there I had on the dollar, and I also want to
Okay.
talk about the dollar a bit later. But the dollar, the counter argument that says the dollar may be near a bottom is, how much more can we price on the US side, right? Are we done pricing? Since they started cutting rates, the 2-year hasn't moved. This year, I mean, the 2-year
Yeah,
has been at
yeah.
3.5% this whole time. So if we're done, then that whole repricing is done. And, the dollar is different than metals. The metals can go to the moon, but the dollar is anchored by rate spreads. And so I think that's a tricky spot for the dollar, even though I lean bearish. I could see the case of a counter trend rally as well. So I just kind of wanted to throw that out there. When we talk
Okay.
about aggregate demand, I mean, this is the corporate sector. This is their earnings profile. I mean, this is parabolic. This is not a small, a short, brief, earnings cycle. This is a record earnings. It's, guidance for next year, as you see on the right, has
Yeah.
exploded higher, highest, percentage of companies raising guidance in 15 years. Caution is completely down. Nobody's cautious, lowest in 15 years. These are the companies that hire people. Clearly, demand is not the issue for the overall economy. That doesn't mean that there aren't certain sectors that are suffering. There is a K-shaped, situation, but maybe we have some labor improvement ahead. Temporary hiring has picked up. That tends to lead the economy. Higher the cyclical economy, I should say. We have job switching wages has popped to 4.6%. Maybe there's some tightening in certain parts of the economy. And then you look at the small business survey, NFIB. This was very important. I don't think it got a lot of press, but you had one of the largest improvements in hiring intentions, going back multi-decades. They had hiring intentions up, they had compensation plans up, they had pricing changes significantly up, and you can see what that implies for payrolls. So it's possible that we have, cyclical upside ahead. I wanted to get, back to the dollar, and I'm just flying through some of this stuff, because from a financial condition standpoint, I think the dollar is the key to everything. So if we look at the last 3 quarters, we basically had the most Goldilocks financial conditions set up possible. We had effectively reflation. Growth impulses were sharply higher, and inflation impulses were also sharply higher, but the Fed was ignoring the inflation impulses. They're basically easing anyway. You could not ask for a better setup for risk assets. And yet, if you look, here, the growth impulse going forward is smaller. It's still positive, but it's smaller, whereas the inflation impulse is quite strong. And so, when I look at what's driving the financial conditions at the moment, I look at these sort of 3-month cycles. The chart on the right is important. The 10-year yield has stopped contributing. Its effects lag, in terms of when they hit the economy, but it stopped contributing. By October, we had the big rally. That's been over for a bit here, and it's kind of neutral. Equities have been consolidating. They haven't been delivering much in the last couple months either. And so where are we going to get like a big easing, coming from? And I think it's really the dollar. So here, the dollar and equities have a negative correlation. If the dollar keeps going, I think it's great for risk assets. And the complicated thing about the dollar from a financial condition standpoint is we got all the easing out of it by July. And since then, the dollar has been either sideways or stronger. And so from a financial condition standpoint, it's a negative contributor next year. And so the last few weeks, we've seen the dollar, it's not a negative contributor in inflation, I should add. But the last few weeks, we've seen the dollar, start to wobble again. And we've obviously seen metals go parabolic. Is that a new impulse that we're getting from a financial condition standpoint? I think that's, the key to every asset class is what we see from the dollar.
Isn't it always that way? I mean, nothing's always, but I mean, if you get dollar direction right, Danny, doesn't that give you a pretty good guide for other asset classes in general?
Especially now when we're dealing with this debasement narrative where, I think if the dollar were to rip from here, risk assets take a leg down, metals would probably, take a leg down. So I think especially now, there's times where it's, less of a factor, but I think right now when we're dealing with this dynamic, it really, really is. And, we'll have to see. Inflation should start to be picking up in Q1, and that would potentially lead to much higher yields and a stronger dollar. So, we have to watch that.
Doesn't the 420 level in the 10-year look like, we break out above 420? It's been very important resistance. We take that out, it could measure 440, 445. Maybe that's a spark plug. It's all based on getting the 10-year back above 420. I mean, they had a chance to really take it down on those inflation numbers last week, and they did for the day, but 420 looks to me like a magnet that it's knocked at the door 100 times, and that resistance is not as strong as it was the first 5 times it got tested.
Yeah, and even beyond that, 4%, we tried multiple times to break and didn't break, and look, I mean, this is not a new story. It's 175 bips of cuts in, and the bond market is not participating. And, the 30-year is, closing in on 5% again. But what's interesting is the 2-year has stopped responding to rate cuts. And so the bond market might be telling you they're done. Yeah, I agree with you that, look, I think fundamentally yield should be significantly higher. I think 5% is where 10 years should be. But
Okay.
I have a number of models that point that way. But technically wise, I agree with you. The charts have been consolidating down here, and it looks like we're setting for a new move, especially if the data comes in better. The economic data starts to come in, better. We did have the shutdown. That was a big reason why the Q4 is a little bit softer and doesn't feel as great, and we get to Q1, we won't have that shutdown. I mean, the data is all over the place that they're giving us, which doesn't help. But I do think before long we will see another run at 5%, over the course of the first half of the year.
Go ahead, Danny. Finish your thought. I'm sorry.
No, I said we'll see what the dollar responds to that. The dollar doesn't always respond to the 10-year, right? Like the dollar mostly responds to the front end, and so we'll have to see what the dollar does to that. If you get a dollar down, bonds down, that's basically early cycle behavior, right? And that's kind of what I'm looking for, because I'm seeing a number of those, small
That's what's
businesses
happening in
like,
Japan. That's
Right.
what's happening in Japan, right?
Yeah, if you get a bear steepener, you get a currency weaker, and you get equities up. I mean, that's a cyclical upgrade. That is a clear growth upgrade, cyclical upgrade. So I think that's very, very important. I know you talked a lot about the metals. I wanted to share some charts on this because it's fascinating. Silver is parabolic. This is my momentum indicator in standard deviation terms, and we're well above 3 standard deviations. To just kind of give you a sense of, how strong this move is, but also, just kind of a warning.
Monster. Yeah.
Yeah, this is a monster move. It's kind of a warning because when you're up here in the stratosphere of over 2 standard deviations, we cannot stay here for long. And you see that, over 2 standard deviations in any of these old periods, it has typically been, where we peak out. Now we haven't peaked out, so that doesn't mean you go short yet, but I think this is a very important, warning that, don't get over your skis with silver. Here's the ratio of silver to 6-month moving average. And again, this is kind of a medium-term indicator. It's not like a timing indicator, but it just tells you how extended we are in a move. And I mean, this is absolutely parabolic on this front. Now, alternatively, the momentum for gold is a lot lower, and it's still inching up. So that's a good thing. It's a positive thing. There's momentum to gold, but it is nowhere near as extended. So my recommendation to clients is to rotate from silver to gold. I've been in silver most of the year rather than gold, but my recommendation is to rotate, and I continue to tell clients, all these metals, whether it's silver, gold, copper, platinum, this is all protection against the debasement, narrative, and you have to rotate. You can't just be in one or the other at all times. You have to rotate around.
It's like the stock market. You have to move even within the same sector. You have to rotate.
Exactly. You rotate. I mean, like people rotate within Mag 7, right? Like Google had its day, then so on and so forth. You talked about Bitcoin, which is lagged.
Yeah,
This
you
is
have a
kind of my
model.
big picture.
I was, you're a mind reader too, Danny. That's what I interrupted you before. I was going to ask you about your Bitcoin model. So go
My
ahead.
Bitcoin model, I'll have an update tomorrow. I update it every Tuesday. Was 94,000, for the last 2 weeks. We hit 94, then came right back, 2 weeks ago, and it's really been struggling a bit, with this level. I think holding above 90K is very important because that's sort of your trend line from 2023. But the big level is going to be 100K. I think Blake was talking about that, before as well.
Yeah.
I think 100K is a very big, important resistance level for Bitcoin. And my model likes it. I'm not someone who's a permanently long crypto or have a permanent allocation to crypto. I trade based on dislocations from my model. And my
Yeah.
model's done really well. It's about a 70% hit rate this year. And it liked it last week at 94, for 94K. I'll have a new update on that tomorrow for sure.
So you have
But,
a model, but you're discretionary about trading it.
No, I'm discretionary with most things I trade, but with Bitcoin is one of my systematic programs where
Okay.
if my model tells me it's cheap or rich,
Yeah.
I'll target that model value. I'll set my stop at half of that, distance, the half of that return. And I just trade it in this fashion. If I get stopped out, I follow, I stick to my stops,
Okay.
and my predetermined stops, and hopefully my gains over time are 2x my losses. And if I have a hit rate above 50%, well then we're making money. And so, I treat it that way. I try not to have a discretionary, focus
Okay.
on crypto in particular. And
You
part of
know,
that is, I'm not in tune to some of the very particular crypto dynamics. Like I can't follow the whale transactions. I can't follow like all this like hash rate stuff and all these
yeah.
dynamics that I just don't have the time for it. So I stick to my model. I don't try to veer from my model with crypto.
Well, Danny, you're a rare breed because you're basically you're macro, first of all. Okay. Your work is like what an economist would be doing. Okay, a lot of your work, and yet you have tactical skills for trading. So you wear all the hats you need. It's usually one or the other, but you're completed. You have both sides of the equation. See, I search for narratives after I see something technical. You have your narratives, and then you find the technical. So I suggest people follow you and check out your Substack and your writings, and it's good stuff. I read it.
I
So
really appreciate that. And don't sell yourself short. Everyone has their own process, and their process,
yeah,
has been honed, works for them. Mine, like you said, is, I focus a lot on research. That research, guides me to build a theme in the markets. That
yeah,
theme can last a while. And then I look at things like you do, the same things you do, technical indicators, positioning, sentiment, narratives, and I try to see, do I have an edge in expressing this theme? If everyone is in the same, view that I have, I don't have as much of an edge, right? And so I try to, acknowledge that. And so that's at a high level, that's my process, is combining the research and signals and things of that nature for tactical trading.
yeah. I bought leaps on myself, Danny. So I wouldn't sell myself short. For 2026, they expire at the end of next year. Anyway, so it was great having you. Best way for people to follow you, Danny, get in touch with you.
Yeah, so follow me on Twitter, Danny Diane 5, and the link in my profile is my macro using Substack. Feel free to check that out where I publish all my macro research. I publish weekly, updates on the dynamics and the risk events for the week. Also, big picture thematic notes. Just published my 2026 outlook. I'm about to post that on Twitter in a couple minutes. I have auto consensus views for 2026, so I think it's something you'll want to check out.
Danny Diane, everybody. Danny, have a great holiday season, and I hope 2026 is your best year in the market ever.
Thank you, Dale. Happy holidays to you. Happy holidays to everyone. And I look forward to chatting again in the new year.
All right, partner. My trading warrior brother, Danny Diane. And 2025 was good. You know why, Danny? We met.
Yes.
Good.
Yeah.
Yeah.
I'm really happy you did. I'm really happy you
Yeah.
did. I'm a huge fan of your process. I catch you. I love the what you do with, with your show every day, and you have a lot of guests, and you kind of take the
Yeah.
back seat, but then you're on Maggie Lake here and there, and I see you take the front seat, and I get to see both sides of you. It's awesome.
I'm bi microphone actual. I could go on either side of a mic. Anyway, thanks, Danny. Have a great holiday,
Thanks,
buddy.
Dale.
All
Have a
right,
good
so
day.
that
Bye.
you too, buddy. So that's a wrap, everyone. You could join the team on the Morning Edge in about 15 minutes. Danny is great. I recommend he'll have you thinking about things that you wouldn't be thinking about on your own. So you're welcome, everybody, and see you, Danny. Thanks again, buddy.